How would I invest $10 million in the current market environment? Let's take a bit of a broader look, dive in and look at different options and what to pay attention to. Hey and welcome to today's video. My name is Julian. On my YouTube channel, it's all about topics on investing. Mainly we talk about cryptocurrencies, Bitcoin. It's all about making you crypto fit, so fit in this world for decentralization, blockchain, understanding what these digital assets are. But we also talk about many other exciting topics: stocks, bonds, general portfolio theory, talk about real estate, precious metal, many cool things. And I've been going on a small little mini series here on the channel where we discussed how would I invest $1,000, $10,000, $100,000. We talked about $1 million last time. And so now we're talking about $10 million. You can also let me know in the comments if you're interested in how would a portfolio of $100 million look like now today. And I want to be very transparent here. So far, all of these numbers, including today's number, I can talk about my own personal experience. I think that's important to note, not so much about, it's not about bragging here, it's really about kind of differentiating. Many people on YouTube talk about theory. Very few people actually walk the talk. And in this case, I really walk the talk. So for me, my entire net worth, liquid net worth, is higher than $10 million. And so I want to discuss a bit how, not necessarily how do I do it right now, because I think that's also a bit private and I want to keep some kind of privacy there, but well, certain things to kind of think about and to kind of note. And I think that's very relevant in the entire aspect when we discuss these things. Before we go into the video though, I want to show or highlight my own company called Cake. Now, if you are into cryptocurrencies like I am, and you own Bitcoin or Ether or many others, you want to check out Cake because we pay some really nice returns on your cryptocurrencies. We're completely transparent about this. So we show exactly how do you get those returns on Bitcoin and Ether. And hey, I'll link it up down below, cakedefi.com. Check it out. Get some really nice crypto flow or Bitcoin flow on your crypto. It's very attractive, super transparent. We're actually the only platform in the industry, at least to my knowledge, where it's all about trusting but being able to verify. And that's the blockchain credo, so I hope you appreciate that. With this, let's go into the writing pad and let's look at a couple of ideas here that are important to kind of mention, right? So we're talking about 10 million. Now the key is, I'll link down below the other videos because you need to understand the other parts already, right? It's all building up. You're not gonna get to 10 million without going through 1,000, 10,000, 100,000, a million first. I mean, that's logic, right? At some point, I mean, unless you the first time you kind of realize you get a lot of money from your dad or from your mom, and then you have $10 million. But it's very unlikely. The more likely scenario is you're gonna go through all those different types of net worth. And the key thing is here, I would probably range it. Again, I'm ranging all of those. Now I have to start with a number in the title, but I would probably range this between 5 and let's say maybe $20 million, right? So that's kind of the range here that I'm talking about. And you will understand why in a second. So really brief, let's talk about the 3 skills in money, right? The very first one is earning money. Remember, most people never learn how to earn money. All they learn is how to sell their time. They get a very low rate on selling their time, so they never actually learn how to earn money. They're stuck in selling their time and they get a really shitty rate. So key thing, most people actually never learn how to make money. The next one is how to keep your money. And that's basically what I call better. Because it's all about keeping money, not losing it, right? It doesn't necessarily mean saving. It's really about keeping money. Very few people actually learn that, right? It's dripping down like a cone, right? A few percent in the world actually ever learn how to make money. Then fewer people actually learn how to keep it. They constantly spend it or they constantly lose it. And then very few people actually learn how to multiply their money or actually send their money to work. That's actually alpha. And I think that's very difficult. It's super difficult to actually multiply your money. And and the biggest mistake I feel that most people are actually making is they don't go down this ladder in learning how to earn money, how to keep your money, how to multiply your money. They always focus on how can I multiply it. So they take these super high risky investments. The reason I know it is because I've done it, I've been there, I've been looking for those investments where I can get rich quick, where the actual proper route is to learn how to earn a lot of money and then not to lose it, and then step by step learn how to multiply. So, and these are things that we actually discussed a lot in the other videos, so let's just keep it in there. But now let's talk about why do I talk about 5 to 20 million. I'll use the example of 10 million just because that's the title. But so basically, if you have your 10 million here, anyone that goes in this route, you need to, it opens up a completely new door in investing. And this door does not exist when you have $1 million. And there's a huge difference in this. Now, when you have $1 million, and we're talking about liquid money, right? We're not talking about, like many times you see someone's net worth being $10 million, but it's not liquid. They have it in a company, they could not loan money against it, and so on, right? So we're really talking about liquid assets. Once you have more than $1 million, you become what's called an accredited investor. And that opens a door already. But this door is quite irrelevant with $1 million. This door becomes really relevant, in my opinion, once you have more than $5 million. More than $5 million, and that's why I have this limit here, it actually opens up the world of private banking. And, you know, as much as a lot of people kind of talk crap about banking in general, once you get through the door and you're on the other side of that door, private banking opens up a whole new world that's, like, in my opinion, crazy unfair to everyone who's not in there. And that's probably the main problem. And there is a good saying why Bitcoin fixes this, because Bitcoin fixes or levels the playing field, right? So I think that's really, 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 really key. So just like be careful in kind of understanding the levels there and understanding the general kind of like steps here, right? But so just kind of understand this. Now, why do I talk about 10 million? Well, it's very simple, because you probably want to split your funds there. One part, and that's a key part, that I would put into a better portfolio. So here it's all about not losing it, right? So the target here is to make around 7 to 8% per year. You diversify, so you have your really nice pool of stocks, bonds, precious metals, you have commodities, you have your Bitcoin, you have your real estate, yeah, you have a cash position here. So, and all you try to do here, right, you try to get beta. That's what you focus on, right? And beta is not about returns, it's about not losing money. So there's some really, really, really key concept. And for you, you need to kind of understand how much do you want to have in there, right? And that really depends on, well, at the end, it depends what you actually want to live on, because that's basically the retirement bucket here. Let's say you want to put in $5 million here. Now you have two options. If it's actually more than 5 million, you could either go into the private banking route. So you could go and talk to a bank and they could kind of set up a portfolio here for you that you can kind of manage. That it's actually, it can be a very interesting solution there. You have some really, really nice benefits there, a lot of access to some really crazy events, great access to like a networking event. So this might actually be a very interesting solution here. But so here, and that's at the end, is a key concept to understand. You don't want to have, and that, it sounds crazy, don't get me wrong, but this is very, very dangerous. You don't want to get your expenses on an annual level higher than the returns this portfolio generates for you, because this is basically your retirement backfall, right? So if this is 8%, so you want to keep your expenses lower than 400K in this case. Now I understand this sounds like crazy a lot for some people, but trust me, when people have 10 million, 50 million, $20 million, $400,000 is not that much in expenses. It's not, believe me. So just kind of put this in perspective, but that has to be a very key concept, right? Your expenses have to stay lower than the portfolio you have in there. Very, very key. And then the other part is, the question is always, how much would you put into this new portfolio? Would you put in like a monthly savings plan, right? Obviously, this makes a lot of sense when you have small amounts. Now, in this case, obviously, it gets very tricky because it's very difficult. For example, here, if you say 400,000 divided by 12, so you're talking about around 30,000 a month, it's quite difficult to add $30,000 to your investment portfolio. So most of the time, actually, you just let this portfolio run. And the plan here is with 7 to 8%, that this doubles every 10 years, right? So it depends what age you're in. It depends on how much extra money do you put in there. But at the end, this portfolio is going to double around every 10 years. That's just basic law of kind of compounding. So I don't know, if you have 30 more years to go, well, then you approximately tenfold it, right? Approximately. So, and the key is you always need to work with safe numbers. You need to work with the lower numbers. Don't work with the higher numbers. Work with the lower numbers. Work with the safety function here, right? I think that's very, very key. And the ultimate here is to actually beat inflation. That's really, really key, of course. So that's kind of your safe function here. And now, I mean, this can vary, right? If you have, let's say, $5 million, well, you might put in $3 million in this portfolio and you work with 2 million. You could do 4 million and work with 1 million, right? But so now what's with the leftover? So here are a couple of questions here. Right? So there are a couple things we've not talked about. So one is, for example, and this is a controversial topic, is your own home. Now, even though, and I'm not pinpointing the exact number of liquid net worth that I have, but I tell you it's way above $10 million. I don't own my own home. And this is a very controversial topic because for many people, their own home is their biggest asset. And for me, I always believe your home is your biggest liability, right? I want to be flexible. I want to be able to move. I'm okay in paying rent because I can, to me, like owning your own home is always a bit lazy because you don't learn how to invest the money properly. Normally, investing money properly, like for example, here in Singapore, I pay between 1 to 2 months per year in rent. So if a property is, for example, $10 million, you pay around $100,000 per year in rent. Now, getting 1% on $10 million is not that difficult. So that's just a couple of things to kind of understand and kind of think. But personally, I wouldn't be totally opposed if someone says, hey, I own $10 million. I have 5 million in this really like diversified portfolio. It generates between 7 and 8% per year. And then I take, let's say, I don't know, 2 million. And it's maybe a 50% down payment on my apartment or 50% down payment on my house, or it could be all money down, whatever. But I mean, I'm not totally opposed to this. And it's actually the very first time that I would say I would actually be okay with it. If you do this when you have only $1 million, I don't know. I wouldn't do it, right? Everyone has their own decisions. I wouldn't do it. So this is just maybe the first thing here. So the second one is private equity or venture equity. And it's actually the very first time that it makes sense. And the reason is also simple. In private equity or venture equity, you probably need to put in at least $1 million. And you probably need to split it up over, like, especially in venture equity, right? If you're talking about the venture capital, you probably need to split it up over at least 20 investments, right? So you do 20 times 50K, better, really, better is 50 times 20K if you can. So you do 50 investments here. Very first time, this actually, in my opinion, really makes sense. So this is something that I kind of would consider. And now you have a couple of other things here. And this is alpha here, obviously, right? So this is alpha. So this is going for returns. Now, obviously, you can do going for alpha on marketable equities on the public markets. I don't know. You could do here, I don't know, maybe $1 million, maybe 2 million. And you really go for some, like where you go into stocks. I don't know. Let's say you like Tesla. Let's say you like Amazon. I don't know. You go for things that you really, 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 really like. So you really go for those things, right? You're going for alpha here. And then if you want, it really depends on you. Here you can go for, I don't know, you can go for some real estate. You can go for collectibles. Or you can actually spend it. you can actually buy luxuries here, right? What you see here, and this is a huge difference than when we go to the next level. So let's say we would talk about 100 million. Now I cannot talk about owning 100 million liquid, right? So this is the last step that I can talk about my own experience. The next step I can't. The humongous difference between someone, and that's why I go between 5 to 20 million, the humongous difference between someone that has, let's say, 50 million or 100 million versus how much money I have is that, for example, I have a beta portfolio of a couple million. I could do maybe one private bank. They could start diversifying. So they can go to Credit Suisse, they could go to Goldman, they could go to JP, they could go to whatever. So suddenly they have 4 or 5. Then, instead of having just one venture capital, they go into different funds, right? They go into a PE fund here, another one. So instead of starting to diversify into small investments, they suddenly start to diversify way larger, right? So very, very, very interesting, right? So that changes the ball game completely. But at the end, what all have in common is you try to keep something in your beta portfolio. Another one here that actually obviously brings a lot of alpha is options, right? So a lot of alpha here. But so the key thing here is what all these portfolios have in common is this focus here. You don't triple down on taking risky investments. You never should triple down on risky investments. You always try to triple down in earning money, and you keep doing this, right? Like everyone that gets to 10 million or let's say 50 million or whatever has their vehicle, a vehicle that just drives them income. They learned how to do this. And then they triple down on keeping their money. And that's the large amount. And then they try to keep their expenses under whatever this portfolio is generating. That's a key thing, right? So if you have $5 million in this portfolio, well, you keep your expenses under, let's say, 400,000 or under 350,000 per year. So you don't go over that. Why? Because at any time you consider that the alpha portfolios you lose, the potential to lose, and then you always keep this. And that's basically the retirement. And then as long as you don't lose it or you just keep generating income, you just grow this portfolio. And then you really focus on the multiplying the alpha here in some very risky capitals. And I'm telling you, I mean, here across Canada on YouTube rides Bitcoin, of course, right? So crypto here, key concept, obviously, right? So you can go and say, you know what, let me drop $2 million, $3 million into Bitcoin. These are the very kind of key things that you need to consider in all of that. But the concepts stay the same. It's just now suddenly you have totally different options. And I think that's a very, very important part. People always think the vehicles change a little bit. The concepts always stay the same. And I think that's very important for people to understand. Most people think that someone with a very large amount invests differently than someone with a small amount. No, it's just the risk that differentiates. It's the profile that differentiates. I don't know. I tell you that most people that I know that have way more money, that the principles stay the same. And that's, we can discuss this in a separate video, but it's really about understanding those fundamentals. Let me know what you think about this. Let me know if you have any questions. Happy to answer those. And if you want to hear the same story, obviously that would be learning from friends of mine. This is not my own experience then anymore. Then I'm happy to discuss this for 100 million liquid assets. And I hope this kind of gives you some ideas, some brainstorming power, and I hope I'll see you at the next video. At the end, quick reminder, check out my company cakedefi.com for some cash flow out of crypto. It's a really, really nice setup, especially right now where you want to hedge against inflation with your crypto and you want to hedge against deflation with cash flow. That's the key things. So kind of never forget those principles. With this, I'll see you at the next video. Thank you so much. Yours truly, Julian. Bye-bye.